This is an accounting quiz to test your knowledge on some accounting 101 concepts. And they're going to be multiple choice quiz questions. You're going to have 15 seconds to answer those questions. And I want to know in the comment section below how many you actually got right. And I want you to be honest about it. How many of the accounting 101 questions did you get right? All right, let's dive into this. What financial statement reflects a company's net income? A, income statement. B, balance sheet. C, cash flow statement. D, statement of assets. The correct answer is A, income statement. The income statement will reflect an entity's revenue and expenses and ultimately its net income. This is your P&L. This is your profit and loss. Question number 2. If you debit an asset, it will increase the asset. B, decrease the asset. C, result in a zero balance. Or D, convert to a liability. Answer is A. It will increase the asset. The natural sign of an asset is a debit balance. So if you debit an asset, you are effectively increasing that asset. You can think about your own checking account. If you make a deposit into your checking account, you're effectively increasing your checking account. That is the same concept of debiting an asset. You are increasing the asset. You are depositing more value into that asset account. A liability's natural sign, its natural balance is A, debit, B, credit, C, neutral, D, credit. The answer is B. It's a credit balance. The natural sign of a liability is a credit balance. So if you credit a liability account, you are increasing the liability's balance. For example, if you add an invoice to your accounting system, you would credit accounts payable, which would increase the accounts payable balance. Which one of these assets is generally classified as a current asset? A, fixed assets. B, intangible assets. C, cash. D, land. The answer is C, cash. Cash is the most liquid asset on a balance sheet and will be classified as a current asset. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. Let's continue going over our Accounting 101 quiz. Question number 5. How long is land depreciated for? A, 35 years. B, 40 years. C, you got to look at the appraisal. And D, you don't depreciate land. The answer is D. You do not depreciate land. Land is land. GAAP does not allow you to depreciate land because the idea is land's always going to be there. There really isn't a useful life. You just keep it at historical cost on your balance sheet. Question number 6. A prepaid expense such as prepaid software or prepaid insurance will be classified as A, an expense, B, an asset, C, a liability, D, stockholders' equity. The answer is B, an asset. Prepaid expenses are generally classified as current assets on the balance sheet since prepaid expenses have a future economic value beyond the balance sheet date. You're going to be taking those prepaid expenses and eventually rolling them onto your income statement. Question number 7. Retained earnings are A, accumulated net income less dividends, B, shares of stock issued, C, dividends paid, D, additional paid in capital. The answer is A, accumulated net income less dividends. Retained earnings is the accumulation of net income from your income statement over an entity's life, less any dividends that have been paid. It's the accumulation of your P&L's net income, less anything that's been paid out to shareholders. Question number 8. Accounts payable represents A, invoices received but not paid, B, paid invoices, C, checks cut for expenses, D, unpaid revenue. The answer is A, invoices received but not paid. Accounts payable represent invoices. These are expenses which you have received. You've incurred those expenses, but you have not yet paid them. You've entered them into your accounting software, but you have not cut the check or made the payment to the vendor. If Achilles Enterprises generates $1 million of revenue from sales and $10,000 of interest income and has $310,000 of operating expenses, what is the net income of Achilles Enterprises? The answer is C, $700,000. We're going to mock up an income statement here in the answer. You have $1 million of revenue. You have $10,000 of interest income. So your total revenue is $1,010,000. $310,000 of operating expenses. You take your revenue less your operating expenses, and you end up with $700,000 of net income. Our last question, question 10. If Odysseus Inc. has $2 million of assets and $500,000 of liabilities, how much is stockholders' equity? A, $2.5 million, B, $500,000, C, $2 million, D, $1.5 million. The answer is D, $1.5 million. Now, our equation for a balance sheet is assets equals liabilities plus stockholders' equity. So if we know what our assets are of $2 million and our liabilities are of $500,000, we know the $2 million less the $500,000 is going to get me $1.5 million of stockholders' equity. And when I add the liability plus the stockholders' equity together, I get $2 million, which balances with my $2 million of assets. What is a characteristic of an intangible asset? A, physical structure. B, raw materials. C, lacks physical substance. Or D, personal property. The answer is C. It lacks physical substance. An intangible asset is a non-physical asset that provides future economic benefits. This can include copyrights, licenses, software, patents, books of business, trademarks, etc. Question number 2. Jackson Enterprises invoices Nakatomi Inc. for Christmas party decorations and catering for an end-of-year party. To record the invoice, Jackson Enterprises accounting team will record what journal entry to recognize the invoice? A, debit cash, credit revenue. B, debit accounts receivable, credit revenue. C, debit revenue, credit cash. D, debit revenue, credit accounts receivable. The answer is B. You're going to debit accounts receivable and credit revenue. The entry to record a sales invoice will be to debit accounts receivable and credit revenue. This is accrual-based accounting. You're recognizing the revenue at the time of service, not necessarily when you receive the cash. Question number 3. Skynet Enterprises buys annual software licenses on January 1st, 2026. The software licenses cost $120,000. The licenses are initially recorded as a prepaid asset. On January 31st, 2026, how much does Skynet Enterprise recognize as an expense? A, $120,000. B, $5,942. C, $10,000. Or D, they do not recognize an expense. The answer is C, $10,000. The math here is the software licenses cost $120,000 and they're good for 12 months. So we're going to amortize, aka expense, $10,000 of the licenses per month. So when Skynet Enterprises is doing their month-end accounting, they're going to expense $10,000 of the software licenses in the January close. Prepaid expenses are expensed from the balance sheet to the income statement once the expense has been incurred. Question number 4. Sister Slime LLC owes performance-based bonuses to its sales team as of 12/31/2026. The company has not paid out the bonuses, but this sales team has fully earned them. What is the journal entry to record the bonuses? A, debit bonus expense, credit accounts receivable. B, debit bonus expense, credit bonus payable. C, debit bonus payable, credit bonus expense. Or D, debit bonus payable, credit accounts payable. The answer is B. You're going to debit bonus expense and credit bonus payable. To accrue year-end bonuses, you're going to debit bonus expense, which is on the income statement, and you're going to credit bonus payable, which is on the balance sheet. Since these bonuses have been earned by the sales team and we're on an accrual basis of accounting, we need to recognize the bonus expense in this period and not necessarily when the cash gets paid out. Chris P. Bacon buys equipment with no salvage value for $50,000. Based on the useful life, it's a 5-year fixed asset. If the purchase happened on July 1st, 2026, how much straight-line depreciation should Chris P. Bacon recognize in fiscal year 2026? A, $50,000, B, $10,000, C, $5,000, D, 0. The answer is C, $5,000. The math works out like this: $50,000 for the fixed asset, and its useful life is 5 years, and there's no salvage value. So we take the $50,000 divided by 5 years, and you're going to have $10,000 of depreciation per year if you use straight line depreciation. Now, we bought this mid-year in July, so we're going to take our $10,000 of depreciation, multiply it by 6 out of 12 months, 50% of the year, and we have $5,000 of depreciation for 2026. Now, straight line depreciation, just as a reference, spreads out the cost evenly over the asset's useful life. Question number 6. Treasury stock represents A, stock issued and outstanding, B, retained earnings used for dividends, C, the par value of stock, or D, stock repurchased from shareholders. The answer is D. It's stock repurchased from shareholders. Treasury stock are shares that are repurchased by the company, which ultimately reduces the number of shares outstanding. These shares have been issued, but then the company goes back and buys them from the shareholders. Question number 7. What does EBITDA stand for? A, earnings before intangibles, taxes, debt, accruals. B, earnings before interest, taxes, debt, accruals. C, earnings before interest, taxes, depreciation, accruals. D, earnings before interest, taxes, depreciation, amortization. The answer is D, earnings before interest, taxes, depreciation, and amortization. EBITDA represents a simple way to determine a company's profitability and cash flow by excluding non-cash expenses, financing charges like interest, and government charges like taxes. Question number 8. What accounting principle states that any revenue earned during an accounting period should have a corresponding expense recognized in that same accounting period? A, full disclosure. B, matching principle. C, objectivity principle. Or D, historical cost principle. The answer is B. It's the matching principle. The matching principle states that any revenues recognized in an accounting period should have the related expenses recognized in that same accounting period. Arnold cuts a check to his accountant to cover tax services, bookkeeping, and personal property tax returns. The amount owed is $1,500, and it was previously entered as an open accounts payable invoice. What is the journal entry in Arnold's accounting system to recognize the check that is cut to pay his accountant? A, you would debit cash, credit revenue. B, you would debit cash and credit expense. C, debit accounts payable, credit cash. Or D, debit expense, credit revenue. The answer is C. You're going to debit accounts payable and credit cash when you cut the check. When paying an invoice entered through accounts payable, when you go to pay the invoice, your accounting system will debit accounts payable because you've already entered the invoice into the system, which is debiting the expense, crediting accounts payable. So when you go to actually pay the invoice, you're just going to relieve the payable, debit accounts payable, and credit cash for actually sending cash to pay the invoice, since we're using accrual-based accounting. All right, don't give up yet. This is question number 10. We're at the very end. John Kimball receives a payment for his detective services. He invoiced his client $10,000, which was recorded in the general ledger. What will be the journal entry to record payment received for the invoice? A, debit cash for $10,000, credit revenue for $10,000. B, debit revenue for $10,000, credit cash for $10,000. C, you don't need a journal entry at all. D, you debit cash for $10,000 and credit accounts receivable for $10,000. The answer is D. We're going to debit cash for $10,000 and we're going to credit accounts receivable for $10,000. Since we've already invoiced our client, when we invoiced the client, we debited accounts receivable for the invoice and we credited revenue for the services that we performed. Now the client is paying us. We're going to debit cash that we have received and we're going to credit accounts receivable to relieve the receivable for those services. One, what financial statement does not reflect a company's cash balance? A, balance sheet, B, income statement, C, cash flow, D, statement of financial position. The answer is B, income statement. The income statement will calculate a company's net income, but it does not reflect a company's cash balance. You are going to have to go to another financial statement to determine how much cash a company has. Question number 2. If you debit a liability account, the liability balance will A, increase, B, decrease, C, remain the same, or D, net to zero. The answer is B, decrease. If you debit a liability account, it will reduce the balance of the liability. A liability's natural sign is a credit balance, so if you go to debit, it's going to lower that balance. Question number 3. Which one of these balance sheet accounts would be classified as a current asset? A, intangible asset, trademark. B, prepaid expense, insurance. C, a rental deposit that is not due back for 10 years. D, held to maturity investment that matures in 3 years. The answer is B, prepaid expense, prepaid insurance. Prepaid insurance would be considered a current asset and will typically cover a period of time of 12 months. This will be classified as a current asset. Professional consulting incurred, such as legal expenses where the company hasn't received an invoice but would be accrued and classified as A, non-current asset, B, non-current liability, C, current asset, or D, current liability. The answer would be D, a current liability. Accrued expenses for services like legal expenses incurred would be recorded as a debit to legal expense and a credit to accrued expenses. Accrued expenses would be a current liability because you're expecting to pay those invoices within the next 12 months. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. All right, let's continue with the Accounting 101 quiz. Question number 5. What financial statement will capture the activity of accounts from the inception of the company? In other words, this report is a rolling balance as of a certain date. A, income statement. B, cash flow statement. C, balance sheet. D, statement of operations. The answer would be C, the balance sheet. The balance sheet will reflect rolling balances of activity going back to the inception of the company as of a certain date. It will break down the accounts into 3 categories in the equation below. Assets equals liabilities plus equity. Question number 6. What account rolls forward all years of net income and dividends declared? A, additional paid in capital. B, accounts payable. C, retained earnings. D, par value stock. The answer is C, retained earnings. Retained earnings is the accumulation of net income for all years less any dividends paid out to shareholders. Retained earnings will be found in the equity section of the balance sheet. Question number 7. If you credit additional paid-in capital during a share offering, it will A, increase additional paid-in capital, B, decrease additional paid-in capital, C, net additional paid-in capital to zero, or D, the balance will remain the same. The answer is A. It will increase the balance. Additional paid-in capital's natural sign is a credit balance. So crediting additional paid-in capital during an equity raise will increase the balance. Question number 8. What type of financial statement can be prepared using the direct or indirect method? A, income statement, B, balance sheet, C, cash flow statement, D, statement of financial position. The answer is C, cash flow statement. The cash flow statement can be prepared using the direct or indirect method. FASB recommends the direct method, but you'll find the indirect method in most financial statements. Question number 9. Hans Gruber, Inc. buys several work trucks for its delivery business. It's typical for the company to capitalize and depreciate these types of fixed assets. Where would you find them on the balance sheet? A, non-current assets, B, non-current liabilities, C, current assets, or D, current liabilities. The answer is A, a non-current asset. Capitalized assets such as automobiles and equipment will be found in the non-current assets section of the balance sheet, shown net of depreciation. Last question. Hope you made it this far. Question number 10. John McClain Enterprises takes out a loan for $1 million with a 5% interest rate, which requires an annual principal payment of $100,000 over 10 years. How much of the loan would be classified as a non-current liability, assuming no payments have been made? A, $900,000, B, $1 million, C, $100,000, or D, $950,000. The answer is A, $900,000. The loan would be recorded and broken down as follows. $900,000 would be a non-current liability. This is what's due beyond 12 months. $100,000 would be a current liability. This is the current portion of long-term debt. $50,000 would also be a current liability. This would be the accrued interest, assuming a full year has passed. All right, that's the Accounting 101 quiz. Please let me know in the comments below how well you did. Thank you for taking the quiz today. Have a good rest of the day, and I will see you in the next video. Take care, and goodbye.